Hello, everybody, and welcome to the show today. I'm really glad you could join us. Today, we're diving into a topic we've never talked about before. But if you're really interested in building a business that's successful and then selling it or exiting the business, amongst many other possible things, this is one of the things that you need to know about. This is a topic you're going to get a lot of value at because we want to make sure that you walk away with as much money as possible. And there's a lot of things even beyond that with tax structures, some other things that we're going to be diving into today. So with us today is Brett Swartts. Now, Brett is the CEO of Capital Gains Tax Solutions. And every year, he equips hundreds of business professionals with a Deferred Sales Trust tool, which we'll be talking more about, to help their high net worth clients solve capital gains tax deferral limitations. Now, his experience includes numerous Deferred Sales Trust, Delaware State Trust, 1031 exchanges, and 85 million in closed commercial real estate brokerage transactions. Now, he's an active commercial real estate broker and investor himself with experiences holdings in multifamily, senior housing, retail, medical office, and mixed-use properties. He is a licensed California real estate broker and holds Series 22 and 63 licenses. He's formerly an associate at the largest commercial real estate brokerage firm in the country and has years of experience and hands-on training from some of the best in the business. Now, as a trustee, he's passionate in educating about capital gains tax deferral with a deferred sales trust, which we're going to talk about, and how to divert from a business or real estate and gain freedom from feeling hostage to a 1031 exchange, and then invest back into and back out of real estate at any time all capital gains taxes are deferred, and we'll talk about that. Brett's considered one of the most well-rounded capital gains tax deferral experts and informative speakers on the West Coast. His audience are challenged to learn to lean into multi-capital gains tax deferral strategies, create and develop passive cash flow wealth plan of their own, and execute on the plan so they can create and preserve more wealth. Brett, thanks for joining me today.
Ty, I'm so excited to be here. Thanks for having me.
I probably messed up a million things there when I just introduced you in that bio. So my apology if that's the case.
No, it sounded great to me.
So let's talk about this. You have experience in both real estate, a lot of experience. We talked about a lot of different areas of real estate, which a lot of people don't have experience in those areas. And you have a lot of experience when it comes to tax strategy as well. So combining those two, what's probably one of the best tax law that aids real estate sales?
Yeah, the most well and best known one is a 1031 exchange. Where you can trade like-kind property to another property in equal or greater value within a period of 180 days. And most of your listeners may have heard of that or have used it themselves. And so that's probably the best. That's one of the best ones, but it has some limitations to it. The other one they may know about is what's called an installment sale or a seller carryback, which if they're business owners, maybe they'd consider doing that themselves, and they've looked at ways to acquire businesses in that manner. That's where basically the seller becomes the bank, and they carry a note in exchange for a down payment and a promise to pay them. And that's another deferral strategy, which is the basis of the Deferred Sales Trust, by the way, which we're going to be talking about more. But those are just two introductions there.
I want to learn more about this because, first of all, we have a lot of real estate investors and agents that follow the show. So I want to talk a little bit more about the 1031 exchange, but I also want to talk more about this, the deferral tax strategy as well, because that's a big thing that can not only just help on the real estate side, but I think also help people that are exiting their business. So talk a little bit more about 1031 exchange. What is a 1031 exchange? How does it work? Why is it needed?
Yeah, most commercial real estate or investment real estate owners, they struggle with capital gains tax, and what they want to look for is ways to defer that tax and earn more wealth. So that's kind of the why behind that, right? Versus paying to the government, it's gone forever. So let's just say, Ty, you owned a $2 million apartment complex and you've owned it for 20 years and you bought it for, let's say, $500,000. Well, if you were to sell today and not do anything, any kind of tax deferral strategy, you'd owe about $1.5 million in a gain, of which you'd owe about probably 37 to 50% of that in capital gains tax depreciation recapture. So it's a big chunk of money that you would pay, but instead you can perfect and do a 1031 exchange and buy another property of $2 million or greater, and therefore you defer all of that gain, all of that capital gains tax, and then you get to earn more on that, right? So that's the idea. The idea is essentially to keep cash flowing. That's where the government gives us these rules, these legal loopholes, so that the funds stay in the marketplace and creating more jobs, businesses expanding. So they're legal loopholes, but for you personally, it's great because you get to create and preserve more wealth versus paying it to the government. It's gone forever.
Which is what we all want, is to protect ourselves, keep as much of our wealth as possible, and not give it to the government, which is a great thing to accomplish. Well, what about tax deferral? I mean, what's the best tax deferral strategy that's out there?
Yeah, so the one that we really focus on, and we think it fits such a need or niche for especially business owners and high-end primary homeowners or artwork collectibles or commercial real estate folks who are tired of the 1031, tired of overpaying for properties, tired of feeling trapped by the 45-day window to identify and 180 days to close, is what's called the Deferred Sales Trust. And it's just an installment sale. And a little bit of background, even backing up a little bit more, is according to the American Bankers Association, there's about 17 to 20 trillion dollars that will pass from one generation to the next in the next 20 years. And this is known as the largest wealth transfer in the history of the planet. Okay, and it's the baby boomers is mainly the folks that are facing this, although a lot of folks are facing it still. And in fact, there's about 10,000 baby boomers every day turn 65, and there's 77 million in the U.S. alone. And they're faced with a big challenge of how do I retire from the toilets, trash, liability, all of the new laws, new regulations for businesses without getting hammered between 30 and 50% of my gain being wiped out. So imagine, Ty, you owned a business for the last 30 years and you worked blood, sweat, and tears. You put everything into it, and the business is now worth $10 million, and your basis is zero. You've depreciated completely out of it. If you were to sell today in California, you're probably looking at 30 to 50%, probably closer to 50%, which means you would walk away with $5 million. And what we're saying is the Deferred Sales Trust, you can put all of it into your trust and have $10 million in the trust. You're going to defer all that tax and you can live off the interest. And so that's what we empower you with, so you don't have to feel trapped by the capital gains tax. And it just makes sense. It's a mathematical equation. Why not have 10 million instead of having 5? And you can put it in stocks, bonds, mutual funds of your choosing based upon your risk tolerance. But the best part of it, and especially I think for your listeners who are business owners, especially for those who are maybe in the tech industry or just those who want to start new businesses, is the ability to have those funds and put it into a brand new LLC and fund a new business venture. Up to 80% of the funds can be used for that. So we call that the Go Fund Yourself. I know some of you heard of the GoFundMe, or you want to look at venture capitalists, but why not use the funds from your previous successful venture, right? And kind of a play on words, right? And use that to fund your next deal. It's exactly what you can do with the Deferred Sales Trust.
Okay, so many questions here, because I'm one of those people that's building an organization, right, with the intention of selling it down the road and then exiting. And then, like many people that are watching the show, my goal is for that to be the retirement funds, right? But in that, I already expect that I'm going to have to take 40 to 50% off the top and give it to the government. Like when my math of how much comes to me, I'm already, boom, 40, 50% is gone to the government. So what you're saying is with this Deferred Sales Trust, I could sell the business, let's use your numbers, for $10 million and then not pay any taxes on that right away. I can defer all the taxes, all the federal taxes, anything that applies in the state, et cetera?
Yeah, so depending on what depreciation you've received, if it's 1245, certain depreciations have some caveats, okay? And every situation is a little bit different. It also depends if you have any mortgage over basis, meaning let's say you owed $1 million on that business of debt and you had a zero basis. That's called mortgage over basis. We're going to have to do a couple things there. We're going to say, Ty, pay that down to the basis, or you're going to pay tax on that, on that million, right, on that portion. So it kind of depends on your particular scenario. But hypothetically, if you had a zero basis and you had no debt on a $10 million sale and all of the depreciation was just, regular depreciation, it wasn't necessarily anything that's personal property, then in that sense, yes, 100%. You can defer all of that under the IRC 453, which is just an installment sale. And let's walk through a little bit how that works. So I imagine I just came to you and I said, Ty, I want to buy your $10 million business. Okay, I'll give you $2 million down payment. Would you carry a note for $8 million? In that scenario, you've received $2 million. Therefore, you owe tax on that $2 million. But that other $8 is in a deferral state. Okay, but hypothetically, if I came to you, Ty, and said, Ty, I want to give you a zero down payment, would you carry a note for $10 million? In that scenario, you received zero, Ty, today. So the other $10 million is in a deferral state. Okay, so this is how it works. The difference is we have this $10 million buyer over here that's ready to buy your business and you're ready to sell it to them. It's all worked out. And where the trust is going to jump in right in between, right before close of escrow. It's like almost a simultaneous close. And they're actually going to give you an installment note for $10 million and immediately turn around and sell it to that cash buyer for $10 million. Okay. And since the trust bought it for 10 and sold it for 10, the trust has what? A zero gain. Since you, Ty, received a zero down payment, your 10 million is in a deferral state. The buyer takes title the same way he would have. He's gone. And the money is sitting in the trust. Where's the trust? Bank of New York Mellon, Charles Schwab, TD Ameritrade, some of the largest financial institutions in America. And it's with a financial advisor, stocks, bonds, mutual funds of your choosing. So yeah, exactly what we're saying. You can exactly do that. And then you live off the interest. Now the interest payments are going to be ordinary income, right? Now, if you dip into the principal, you're going to pay capital gains tax on that proration of that. So let's say you want, hey, I want $1 million to travel the world with my family. Okay, if you dip into that, you're going to pay taxes on that $1 million. But the other $9 million is still going to be deferred. Most of our clients like to pay the tax the second day to never, meaning they're just going to keep it deferred and keep living off the interest. They're 10-year notes. At the end of 10 years, you can renew for another 10 years and then renew for another 10 years and just keep going, keep going, keep going. You can pass it on to your kids. Okay. And also, again, the best part, I think, for entrepreneurs, for your business professionals, for your commercial real estate listeners, is the ability to use up to 80% of the funds to go into a brand new LLC and partner with your trust to buy a brand new deal at any time. So you can sell high and buy low, okay? Meaning buy whenever you want or never buy again, right? But buy when the market makes sense, right? Diversify your holdings in multiple commercial real estate deals. Back to a little bit about the 1031 exchange. One of the biggest challenges is that it forces you to buy typically one property within one location within a short period of time. So you're neither diversified, you're neither liquid, and you're probably overpaying for a property oftentimes because it's a seller's market. You're buying within that 180 days. The Deferred Sales Trust, on the other hand, solves all of that. You can get diversified, you can get liquid, you can put it into 15 different commercial real estate syndication deals, right? You can do it with yourself or other partners. So it's very, very flexible. And the other biggest one I think would be for the debt. So for any of your business owners who have a lot of debt, the other thing is we can get, when we sell, all the debt is paid off and just the proceeds go into the trust. So we call it the debt-free plan too for your business or commercial real estate. So there's lots of parts of the benefits for your listeners. I'll pause there because you probably have some questions or comments.
Yeah, no, I think it makes a ton of sense. So ultimately, I'm selling the business, but instead of getting cash, I'm basically doing it through a trust where that money's protected. So here's one of my questions. Let's say I put 10 million in there. Let's say I don't even want the interest, right? I've got other things that are paying me. So that 10 million now grows, right? Because I'm not taking the money out. Well, then am I able to take that interest that I obtain without it being taxed? So let's say I do the 10 million, I don't take the money out because I've got another business that's making me money, right? Now let's say that 10 grows to 12 million. Well, then am I able then to take that 2 million out without paying the taxes I would pay as if I was selling the business?
Whatever you take out is going to be taxed. The question is,
and by that I mean, like you and I both know that if I put money in Vanguard, right, and I take money out, I'm going to get taxed on that money. Like I get that. But what I'm saying is, let's say all this money goes in, then am I taxed the same as if I would have been if I just sold the business normally without the trust on the interest that's accumulated on that money?
So a couple things there. So let's walk through, and I think I can answer your question here. So it's 10 million sitting there, and right now you're like, look, I don't need the income. I make plenty of income right now. I want to just keep it growing right now. I kind of want to just wait, which is actually a great strategy for a lot of our clients, especially if they're going to relocate to a tax-friendly state, such as like Nevada or Florida or Texas, a few others, especially if they're coming out of California because it's really tough. So what they'll do is they'll sell their business, put it into Deferred Sales Trust, and just say, look, for the payments, I don't want any payments right now. Just let it just build on top of the trust. Okay. And then when they move to a tax-friendly state and establish residency, then they can say, yeah, now let's start pulling out the income that's produced. Now, when they receive that, it's going to be ordinary income, right? As long as they haven't dipped into that $10 million principal. But the moment that $2 million gets eaten up, that you've lived off, then it's going to dip in, and then you're going to pay a proration of capital gains tax, right? So there's a couple layers to that. The first one is your overall tax bracket, right? We call it tax engineering. When would you like to pay the tax, and how does it best fit you, Ty? Perhaps you have a loss in a couple of years on a business venture or commercial real estate deal worth $2 million. And you say, Brett, I had $2 million accumulating over here. I just had a big loss over here. Is there any way to offset or even dip? Maybe it's a $4 million loss. Maybe I can dip in to more. So it's your money, Ty. How do you want to receive it? And every time you look at it, we'll say, look, you're going to pay tax based upon this. We'll work with your CPA to figure all of those things out. But the key is the moment you pay the capital gains tax, it's gone forever. Another way to think about it too is it's kind of like a zero interest loan from the government. They say, Ty, we know you owe us $4 million, but as long as you invest that $4 million into stocks, bonds, mutual funds, a business venture, commercial real estate, you don't have to pay that back right now. Now, the interest that's earned off of that, you're going to pay us taxes on, but that $4 million you can go for as long as you want, to keep it deferred and keep it in the economy moving. So that's why they set these legal loopholes up. And this is why, by the way, it's a 1920s tax law. We've closed thousands of these. And if anyone ever comes to you with a new tax strategy, you should ask a number of questions. One, what's a tax law? It's IRC 453, which goes back to the 1920s. Okay, it's the oldest that we know of tax deferral strategy. And compared to the 1031, it's 1954, and really didn't become popular until the Starker Exchange case in the 80s. And then even then, no one really kind of knew about it until the 90s. And still people don't know about the 1031 exchange, right? So ours goes back to the 1920s. Second thing you should ask is how many have you closed? We've closed thousands of these: self-storage facilities, veterinarians, tech companies, apartment complexes, you name it, trucking companies. All across the board, we've closed transactions. The next one you should ask is, well, how many IRS audits have happened, right? And it's not just have anyone got audit, but they actually looked at the structure. So 14 no-change IRS audits, of which the largest one was a $125 million deal in San Diego. Not one single issue with the trust or the structure. There was 2 formal audits. These 2 formal audits, same thing, not one single issue with the structure. And so it works. We've blazed the trail. But all that being said, however you want to receive the funds is yes, that's the answer, right? Basically, and when you do, you'll pay tax on that.
Okay, so obviously tested, proven, and I like that because what you're saying is, look, it's been through audits and it's held. So that being said, what are some things that you need to make sure you're doing when you're setting up one of these, we'll call them DSTs, when you're setting up this deferral strategy, this deferral tax strategy, then what are some things you need to make sure that you're doing to make sure that you're not going to have problems with the IRS if you are audited?
Yeah, just be early, right? Meaning that we're making sure we're working with your business broker, your attorney, your CPA, everybody early who's setting up the M&A attorney, whatever, right? We're putting language into the document that basically states that the seller has a right to a deferred sales trust at no additional cost to the buyer, okay? And when we establish that language early, we establish it as a placeholder in case the IRS said, what was your intent when you were going to sell your business? Was it to defer it, or did you throw it into the very last minute when all contingencies have been removed and all of a sudden you threw this in to just defer or avoid the tax, right? Say, no, we had this very early from the very beginning. So I would say the best way to digest this and make sure everybody feels good and comfortable is getting to know us, get educated on the structure and strategy, bring in your trusted advisors, right? So we understand that you're hearing this thing for the first time, most of you, and it seems like it's too good to be true. And it seems like there's something here that I'm missing, but we want to bring in your trusted advisors, who we call the brain surgeons, Ty. And we say, who are your brain surgeons? So the tax attorneys and CPAs and your trusted financial advisors you've had for years. And bring them in to talk with all of our brain surgeons, right? And make sure it all fits before you get surgery. And by the way, on our end, we don't charge anything unless and if the client closes on the trust and unless and if the deal closes. So it's no cost, no obligation, no pressure, right? Just check it all out, look it side by side to see what you want to do there. So yeah, that being said, if there was an audit, by the way, there's audit protection that's built in, lifetime audit built into the trust. The attorney stands behind his work who created the structure. He's a CPA tax attorney and Campbell Law Firm. They do a great job. I'm just a trustee, by the way, which is my role. I'm just kind of like the nurse, Ty, right? I take your pulse and I say, yeah, it looks like you have a capital gains tax deferral issue. And you may want to talk to the surgeons here, all right? So I do the initial intake, the initial education, and get you prepared as much as possible. So by the time you get to the surgeon, he's just doing surgery, if that makes sense. But that's really it. Hopefully that answers your question there.
Yeah, absolutely. Now, you said this works for a lot of different industries. You named several of them. So if I sell whatever kind of business I want to sell, this should work for me.
Correct, 100%. In fact, business owners are the number one because I've yet to find a business owner who's done a 1031 exchange. And the 1031 exchange laws have become more restrictive. So artwork, collectibles, automobiles, all of these other assets are no longer available for 1031 exchange. The 1031 is really only for a small piece, which is investment real estate. The other big one to mention is high-end primary homes. So a recent deal was in Newport Beach for a couple who's getting a divorce, a $26 million sale. and they owed $6 million above their 121 exclusion, which is essentially, if you live the last 5 years in your house, Ty, and you're married, you have a $500,000 exclusion on the game, or if you're single, it's $250,000. Well, above that, they owed $6 million for this couple. And so they used the Deferred Sales Trust. It solved their issue, and they were so happy, right? So yes, it works for primary homes. It works for businesses. It works for commercial real estate. If you have a failed 1031 exchange, we have saved multiple failed 1031 exchanges in the past few months alone. So just for example, you're out shopping for your deal, and the deals aren't working out. It's day 170. You're about to pay the tax. You have no options. Well, between day 46 and day 181, any time between those time periods, we can default into the trust, and it saves a failed 1031 exchange. Again, it doesn't cost anyone anything to have that option, but they need to get to us early. They need to be talking with us so we can prepare their qualified intermediary. We can prepare their real estate broker to make sure that the funds are sent to the trust rather than being sent to themselves, which personally means they've taken receipt, which means they owe the tax. So be early, connect with us, get educated, and then ride the bike. The first time you ride any bike, it's a little bit awkward, but as you start to ride the bike, you get a little more comfortable, and that's what we want to do for you.
So, Brett, talk to me a little bit about comparing this to 1031 exchange. Obviously, an entrepreneur, I'm not aggressively in the real estate side, but we have a lot of our listeners that are. So I want to dive in a little bit more in that because a lot of them are new to this strategy. They haven't heard of this strategy, and they probably are going to want to compare this to the benefits of what a 1031 exchange could do for them. So can you speak to that, comparing on the real estate side, the benefits of this over a 1031 exchange?
Yes. And by the way, my background is at Marcus & Millichap, where I started and actually learned about this structure for the first time 10 years ago. And I help people buy and sell multifamily properties in Sacramento, California. I'm still a commercial real estate broker. I still do 1031s. So I love the 1031 exchange. And the 1031 exchange has, again, some benefits of tax deferral. And especially if you find a good value add opportunity to buy, hey, go for that. But what we say is don't overpay just because of the capital gains tax. Another way to ask the question would be, would you buy this property if it wasn't for that 30 to 50% getting wiped out? And if the answer is no, I wouldn't, well, then consider a deferred sales trust, right? Because that's exactly what we're here for. We're here to get diversified, get liquid, and then wait for optimal timing. It could be a couple years from now. It could be a different marketplace. It could be a development deal too, by the way. We can develop with it. The 1031 is very restrictive in timing and also in like kind. And those are the two biggest things. It has to be investment real estate for investment real estate. It has to be within 180 days. The other thing it does is it basically forces you to maintain debt. And we think debt it can be good when in a buyer's market. When you find a deal, we call it smart debt, risky debt, and dumb debt. Okay, smart debt goes into debt when you find an opportunity, a value add opportunity. It's a buyer's market. Real estate's low. Everything's in the tank, kind of like 5 years ago, especially in California. But right now, we call it risky debt. If you maintain debt, you're risking the equity you've built if you're not doing anything with that. And then dumb debt, dumb debt is when you double down and you exchange into a bigger property and you maintain that debt or get even more debt. And that's what happened in 2008 when the marketplace really took a hit. People were exchanging in 2005, 2004, 2005, 2006, 2007. The music stopped, and some of them lost everything. So the alternative or the solution is get out of debt, get diversified, get liquid, and buy real estate when it makes sense with the deferred sales trust. The last one has to do with depreciation, okay? So in a 1031 exchange, the depreciation schedule travels, and that's not good. So one of the best reasons to own real estate, Ty, is the offset of the depreciation versus the income. Okay, so you get all of the income, but the depreciation offsets it so you don't have as much tax. Well, eventually that lowers your basis, and then when you do a 1031 exchange, you travel with that basis, which is not good, meaning you have to buy a much bigger property to get the same amount of depreciation. Not so with the deferred sales trust. The deferred sales trust is a solution for that because when you partner with your trust, you get a brand new depreciation schedule. So the same $10 million deal, let's just say you were to buy through your trust or do a 1031, you get a brand new $10 million full depreciation schedule to offset your income. Very powerful, especially if you couple that with accelerated depreciation, okay? So those are two things. The downside would be this, okay? The 1031 maintains the stepped up basis. That's a good thing, okay? Meaning, Ty, if you were to pass away, right now as the law states, your family gets a stepped up basis, meaning they could walk away essentially tax-free, okay? However, the deferred sales trust does not do that, meaning you can still pass the trust and it's still tax deferred, but if they were to sell, they're not getting a stepped up basis. That's part of why they're getting a new depreciation schedule. Here's the big however, though. Who's to say that the stepped up basis is still going to be there, 5, 10, 20 years, especially with the 22 trillion that the government's working against. And they're talking about limiting or getting rid of the stepped up basis and or limiting or getting rid of the 1031 exchange. So we always say, just keep that in mind for why to stay in that. And then the other one would be for the estate tax. Okay. And the estate tax for the 1031 exchange, it doesn't change that, meaning that's not good. Where at the deferred sales trust, we can move funds outside the taxable estate. So these would be for your ultra high net worth listeners right now. So let's just say someone's worth $52 million. The first $22 million is exempt if they're married in their estate. If you're single, it's $11 million right now. But anything above that number is going to be hit with a 40% death tax, okay? So let's just take 52 million minus 22. That's 30 million. Well, if that's all of that 52 million inside their taxable estate, that estate's going to be hit with $12 million estate tax, okay? The deferred sales trust can solve that in that we can move all the funds outside of the taxable estate in one single transaction. So if you had a $30 million business sale, we can move it all outside the taxable estate. The 1031 exchange, although it got the stepped up basis, let's say to 52 million, it's the estate still owes the estate tax. That's separate from two, okay? So that's a key distinction between us and the 1031. Again, we call our company Capital Gains Tax Solutions, meaning we want to present the pros and cons of each of the major tax deferral strategies, and then let the client decide. And by the way, they may want a mixture of 1, 2, or 3. They may want to do, a third of a Delaware statutory trust, a third of a deferred sales trust, and a third of a 1031 exchange. The question is, what are their needs? What are their goals? What is their risk tolerance? And how do we work as a team to help you solve that?
Brett, that's fantastic, lad. I like how you presented that. And I think it makes a bunch of sense, which is the fact that there's different options. It might not work the best for one person, or one strategy might not work the best. That being said, what about tax law changes? Because obviously Republicans, Democrats, we see all kinds of changes as people change office. Now, you said that, this strategy has been around since 1920, so obviously not a risk of it going anywhere. But that's something I would worry about, right? Is I worry about deferring all this, and then a new president, comes into office and recognizes that all this money, which has to be trillions maybe, is outstanding deferred, right? And then makes a change to come in to want to grab some of that money. What's your thoughts on that?
Yeah, for the 1031 exchange, it's definitely a concern. In fact, that was a part of the proposal for the recent Trump tax plan. And fortunately, they kept the 1031 in, but again, they limited it, right? So what we're seeing is as $22 trillion in debt and growing, a challenge for the government to bring in tax dollars, right? And they have to continue to bring in more for all of that debt. And so what are they doing? They're talking about limiting or getting rid of the stepped up basis, limiting or getting rid of the 1031 exchange. That being said, do we think could they take away the installment sale? Could they take away, in that sense, the deferred sales trust? Yeah, they could. Do we think they're really looking at, paying attention or really focus on it? No, not as much as the 1031. Do we think it's likely? We don't think it's likely. And we have national law firms that review this every year. By the way, we have thousands of professionals now across the U.S., including CPAs, national law firms, tax attorneys, financial advisors, business brokers, commercial real estate brokers. We've closed deals with, Marcus and Millichap, Colliers, all these big groups. Anyways, the point of all that is they've reviewed and they look at these things every single year, and they say, what's the risk of this being taken away based upon the legislation? Generally speaking, we don't think there's a lot of risk for the installment sale, but hypothetically, yes, they could. And let's say if they did, what would happen? Well, generally speaking, based upon the past, they grandfather folks in, right? And then they say moving forward in the next, at this date, no more, right? So there's a lot of ifs and hypotheticals, but we do know it's a 90-year-old tax law. And as of right now, that we're aware of, no legislation to affect the installment sale, IRC 453.
That's awesome. I mean, this is brilliant. Like I said, for anybody that wants to sell their business, I think this is something that a lot of people don't even know is possible. And what's nice about that is that it could save you, man, it's 40, 50%, like you said. I mean, that's a huge amount of savings that goes in your pocket. Anything that we haven't covered, as we get ready to wrap up, anything that we haven't covered on this Deferred Sales Trust that I should have asked that maybe I haven't, or things that both real estate investors and people that are just growing a business with the intention of selling it and exiting should know about this?
Yes, great question. And I would start first with the business professional. So if you have any business brokers, financial advisors, commercial real estate brokers, or high-end realtors who are listening, we really encourage you. In fact, that's our passion, is empowering business professionals to help their clients defer the capital gains tax using the Deferred Sales Trust. And right now there's an automation technology revolution going on, which you've probably heard of, right? Where a lot of the value proposition for every business professional is being challenged. Meaning, what is the value that I'm getting for hiring you, right? What is your fee worth that I can't perhaps have a computer or automation do, right? And we feel that the Deferred Sales Trust adds so much value to the conversation because it solves the internal motivations of these business owners who are trying to sell, who feel trapped by capital gains tax, who feel, just overwhelmed by the 30 to 50% just being wiped out after they've worked all their lives. And when you can walk into a presentation or opportunity to say, look, I'm going to tangibly help you save 30 to 50% right now, that's worth so much. The fee discussion kind of goes away because the value's there, but also it helps to differentiate yourself from every other professional out there. So we really want you to be, empowered with this strategy. We want to be the guy as a part of your team to support you in that. We have a whole marketing team. We have a whole CRM system. It doesn't cost you anything to be a part of that. We just want to give you the opportunity to educate more folks. And then back to the business owners, I challenge you to lean into multiple capital gains tax deferral strategies, and even if your CPA hasn't heard of this or doesn't know it, perhaps they're more of a general practitioner. Ty, if you go to the doctor and you have a general doctor, if at a certain point he can't do brain surgery, right? He's not going to do the ACL reconstruction. And so although they may not know about it or never heard of it, it doesn't mean it doesn't work. And it's not we have a surgeon who's done thousands of these and has survived 14 IRS audits. He's a CPA tax attorney, created structure. So don't just, say no because someone hasn't told you about it. Bring them into the conversation and have everyone talk and discuss it and make sure we really, really go. Because at the end of the day, it really, really go into the structure and get your approval and get their approval. Because at the end of the day, you're the one who's paying it. It's not the CPA who's paying your tax, right? And by the way, if you pay the tax and you lose anyways, it's gone forever. But if you can defer it for 1 year, 2 years, we've been doing it for 23 years, every year that you're earning a little bit more on it, to us, that's winning, right? So yeah, that's it. Just get to know us, connect with us, and give us a chance to educate you.
Brett, where do they go to learn more and to talk to you guys?
Yeah, so capitalgainstaxsolutions.com is the website. You can find me on LinkedIn, YouTube, Facebook, Bigger Pockets. And we also have a no-cost free webinar. If you just email me, I can send that to you, and that will give you basically this presentation that we talked about, but it's gonna show you visually how this works. I did a recent one with a gentleman named Charlie Dobbins. He's a real estate attorney, and we had 190 people on the call, and people are asking questions. We're going back and forth, and so we want to give you all of those resources to get educated on the structure.
Awesome, Brett. Thanks for joining us today.
Thanks, Ty. My pleasure.
So everybody, make sure you visit capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. All of our shows are at creditsuite.com/podcast. I will put that LinkedIn and Facebook links up on the show resources page. But again, you want to visit capitalgainstaxsolutions.com. So words can't express how big of a deal this is, because anybody that's building a business to sell a business, if you really understand how much money will be taken in taxes, then you're basically trying to build a business double as big as it needs to be, because you don't want to have to pay the taxes, right? So if you want to walk away with $1 million, well, then you got to sell your business where you're going to walk away with $2 million because the government's going to take half. Well, you just got a solution where you don't have to do that. You can actually defer the taxes, not pay the taxes on that money. And even best, as Brett said, you can reinvest that into another business and then use that business to even make money. So there's so many different options here. If you're in real estate, it's even then some, right? This could be a significantly better option than 1031 exchanges. You don't have to worry about the time constraints and a lot of the other drawbacks of 1031 exchanges that Brett talked about. But most importantly, in my world, man, this is a huge deal for selling a business. I mean, it saves you millions, if not tens of millions of dollars, depending on how much you sell for. So make sure you visit capitalgainstaxsolutions.com. They've got a bunch of great information on the site. Learn a little bit more. And if you really are getting to a point where you're ready to, if you are a real estate investor, you want to learn more about this, you're getting to a point where you're thinking about selling your business, the exit strategy, those things, get with these guys early. Make sure you schedule time to get with them early so you can avoid millions of dollars in taxes and keep more of what you make, which is, as entrepreneurs, what we all really want to accomplish. So make sure you visit capitalgainstaxsolutions.com and make sure you really consider this before using 1031 exchanges, or even before you think about selling your business to keep more money in your pocket.